So good afternoon, everyone, and welcome back to our second session of the Foremost Builders IQ series. I'm Matthew Belcascio, a mortgage analyst here at Foremost Financial, and I wanted to thank you all for joining us today. Today's event is sponsored by Pelican Woodcliff Inc. Pelican Woodcliff is an independent multidisciplinary real estate advisory and cost consulting firm that increases the chances of project success by ensuring their clients are suitably informed with their real estate development decisions. This event is in support of Layup Youth Basketball. Layup is a cost-free, community-based basketball program designed for children and youth of all skill levels. Layup's vision is that all children and youth in Toronto have the opportunity to be equipped for success through a fun, inclusive, high-quality approach to basketball. In response to COVID-19, Layup designed a virtual program last summer and provided the necessary physical activity, social connection, and mentorship at a time that is needed the most. Here's a quick video highlighting the virtual program.
Happy Monday, everybody. Before we get started, I'm just gonna have everybody drop an emoji in the chat.
If you're feeling amazing on this Monday afternoon.
First thing we are gonna do is 10 lunges. And keep going halfway there.
7, 8.
Queen of diamonds, go, 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 get back, get back.
One hand, your right hand.
Alex is trying to get as many small movements as he can.
Okay, three-pointer, let's get him to get some three-pointer.
Jump to the right. Reverse to the right.
Good job, Kamina. Good job, Serena. Good focus, AK.
Last thing, everyone should have been wearing their favorite color.
Everyone just wanted to do it, so it was a really fun drill.
Layup on 3, family on 6. 1, 2, 3, layup.
Thank you for all my coaches, that all the people that made this stuff. Thank you all. When I grow up, I want to be a coach, just like Coach Bantu and all of my other coaches. I want kids to look up to me as much as I look up to all my other coaches.
So we please ask that if you enjoyed today's event, to please make a donation and remember that no amount is too small. I will be sharing a donation link in the chat section below. Now, before I send this off to our host, Max Miller, I wanted to remind everyone that any questions you may have can be asked in the Q&A section, and we'll have some time at the end of the presentation to answer as many of these as we can. Also, this event will be fully recorded and put up onto our YouTube page, along with clips on our other social media platforms. Without further ado, I'd like to welcome our host, Associate Vice President of Mortgage Lending here at Foremost Financial, Max Miller, and our guest from Pelican Woodcliff Inc., Donny Afonso.
Thanks, Matthew, and welcome everybody to the Foremost Builders IQ series on infill construction costs. Today we're joined by Donny Afonso, who's the principal at Pelican Woodcliff. I think this should be a very interesting discussion. We're going to try to take a look at some of the macro and micro trends that are currently impacting infill construction costs. I think Donny's got a very unique and hands-on perspective of the situation, and we're hoping that this discussion kind of help navigate through some of the volatility we're currently seeing in the space. So just before we start, I'd like to say thank you once again to Pelican Woodcliff for sponsoring this event. I can speak on a first-hand basis. Pelican is Foremost go-to for project monitoring and cost consulting on our large complex deals. So if you're in need of any of these types of services, I'd highly recommend getting in touch with Donny and his team. So Donny, thanks again for joining us today. Just to start us off here, if you could just give us a quick background on yourself as well as Pelican Woodcliff, just to give our listeners perspective on just some insight on your perspective on today's topic.
Thanks, Max. Appreciate being here and welcome everybody. Yeah, my background, I've got a bit of an accent if anybody can tell, but basically grew up in South Africa, came here in 2002. Most of my career has been in Canada. I'm working in the quantity surveying and cost consulting fields, from when I graduated, and I've been pretty involved in the industry in various firms doing mainly loan monitoring. So that's the field that I specialized in. I'm a past president with the CACQS, that's a Canadian Association of Consulting Quantity Surveying, and I'm the current chair of the Ontario chapter for the CICQS, which is the Canadian Institute for Quantity Surveyors. So I'm also principal at Pelican Woodcliff, as Matt and Max kindly mentioned. We're an independent cost consultancy that work with many of you essentially. So.
Great. So just to start the discussion today on construction costs, I figured it would be best to take like a high level kind of macro approach to the topic and look at some of the commodity prices that we're reading about every day in the newspaper and kind of see how they're impacting construction material costs. So can you give us just some insight into which construction materials you're seeing having the largest impact from these rising commodity prices?
I'm thinking that a lot of the audience is actually mainly in the low-rise field, and the one line item that everybody's talking about is lumber. So the lumber commodity is one of the ones that's had a huge increase. I mean, at least 50 to 7% year-on-year increases, and they seem to be keeping going. And that would be a big direct hit on low-rise, because your framing and supply of lumber is one of the big items that you actually have as a component. So it could be as much as a third of your budget is going into the structure, and that being steel for a stick frame or lumber structure, it's a pretty big hit. So the steel is also another big item. Lumber is mainly a supply. The lack of supply from the closing BC mills, just before the pandemic, and then when the pandemic happened, we ended up having that matched with a demand issue, which is, a lot of the pandemic was starting to focus. People were starting to focus on more projects on the low-rise side, and not only in Canada, in the US as well. In the US, when their housing starts get started, it has a huge impact on all our commodities. So you had the demand and the supply hitting the market at the same time, and mills opening up, it doesn't seem to be keeping up with the demand issue, but the reality is that's apparently the background for the lumber commodity. The steel commodity, I understand, is it's things to do with the US China negotiations, affecting the supply. The demand impact from housing starts obviously being a big one as well. But I mean, the fact that we've got probably around 50% increase in 1 year in steel commodity is another one that's impacting a lot of line items, and that affects like a lot of the trades as well. But it seems to be the main impact is on rebar. Low rise, you're not as impacted by rebar, but I mean, when you get into the high rise, that does start to be a big impact on your structure that you've got as concrete trades. A lot of those commodity impacts flow all the way through to other budget lines as well on the high rise.
Yeah. So I mean, definitely interesting times, and we're definitely seeing a lot of volatility in the commodity space. It seems like there are a lot of interesting supply and demand factors at play here. A few that you mentioned, I know in our discussion, you kind of highlighted that a large piece was kind of the flight from downtown core living to more of a rural type living, where the homes typically kind of stick build, use a lot more lumber. Obviously, based on my research, I saw there's a lot of the supply chain expected kind of recessionary pressures from COVID, which never really happened. So they kind of pulled back their production capacities with that expectation, and now it's still taking some time to ramp up. And obviously on the demand side, you're seeing a lot of liquidity in the space right now that are chasing hard assets, and a lot of people have been stuck in their homes for the past year or so. and kind of are now wanting to improve on that and putting a lot of money into renovations or new builds. So there's a lot of supply and demand factors which seem to be impacting the commodities. So from your perspective, do you see these rising costs as being driven by kind of secular long-term inflation? You hear a lot in the news of discussion with the U.S. Fed and inflation, or do you see this kind of being more of a short to medium term phenomena that is being caused by some of these supply and demand factors?
Yeah, I think the reality is nobody has the crystal ball. Everybody wishes we had the crystal ball to be able to predict what's going to happen. But I think it seems like everybody's thinking that as soon as they have some extra mills open, there's some mills in the US for steel that are opening now that steel pricing maybe makes more sense for them, or they're seeing that the demand's there to be able to make money as well. So as I think on the supply side, you've got some solutions that are happening that potentially could make it a short-term to medium-term issue. The hope is that it gets back to the traditional, 2 to 4% on increases in any line items, any given line items, or as a blend that you're at the 2.2 to 4% kind of cost index or cost increases level. But yeah, I would say short to medium, and I think from a perspective of the pandemic impact on the commodities. The pandemic seems to be taking turn in the US, and there's a lot more signs that we're nearing the end of our pandemic here in Canada as well. So the hope is, when the pandemic starts to end and the supply starts to come up, that all these impacts on commodities would take hold, and we get back to usual business, right?
Yeah, and it's really interesting. Like, it seems like we may be in kind of a perfect storm type situation here. I on some of my research, it mentioned even the recent forest fires in BC kind of had an impact on the lumber production out there. So it seems just like a bunch of factors coming into play. So it's going to be very interesting to see how this plays out. I thought another interesting point that I saw in my research was kind of when I first started looking into this topic, I was able to find a BMO report on commodities, and it had mentioned obviously there's approximately a 400% increase in the price of lumber currently, and that they expected a drastic drop off in the second half of this year, and going forward into next year. Drop off, I think it was approximately their figures had it basically back to the same level as a year ago. So like a complete drop off, 400% increase. And the funny thing is, I actually pulled that report because I had it linked in my notes. I pulled up that report recently again, and a completely new report popped up from that exact same link, and they had seemed to shift their beliefs in the future of lumber prices to a much more moderate drop, kind of not probably, I think it was around double as to where it was last year. So it's still a drop off around double where it is last year. So I think that basically just tells us that there's obviously a lot of volatility in the space, and at this point it's really a guessing game of that, how things happen. So it's going to be very interesting to see how this plays out. But clearly there are kind of a bunch of supply and demand factors that will hopefully smooth out over the short to medium term, and some of these costs can normalize. So just kind of if we take a more micro approach to construction costs and look at it from kind of the perspective of on-site costs, can you just dive kind of a bit into that side of things, where the cost increases are from a day-to-day type point of view?
Yeah, thanks. That's a good question, because the reality is we're not commodities specialists, and I think I'll leave that for analysts in the market and things like that. But when it comes to how it affects the sites, you use the words perfect storm, and that seems to be what's happened on the trade level on the sites as well. So you not only have increases in steel and lumber, you have oil, which impacts some of the trades as well. So, but the direct impact, obviously, for low rise is the lumber supply The actual framing seems to be up as well, and that may be more because of the COVID pandemic. A lot of the drywall trades on the labor side, they're charging more, possibly because they're building in the productivity factors that are coming with the social distancing rules from the COVID pandemic as well. But I think steel, that impacts a lot of line items, and I think really a lot of people haven't really fully understood the impact on the supply chains yet, but from your appliances to the sheet metal that goes into your ducts, to the rebar, obviously that's a big impact on the high rise, but on your low rise you also have an impact, and high rise, your drywall would be impacted by the steel as well. So there seems to be a lot of impact on various line items, and I think a lot of the developer clients out there, they just feel like they're being hit from all angles on all these increases that are coming. But we're talking about cost increases. What about the supply? Like the actual fact that before you just call up and get something delivered to site the next day, now you're waiting 2 to 3 weeks for it, and that being an integral piece that you need before your trade can keep going again. It is starting to impact schedules as well, and that's another big hit. Not as micro as some people would believe, because earlier the quicker you get your project done, the less interest you have, and the quicker you get your equity out. So I think it's a pretty major impact on a micro level, I guess.
Yeah, and I know with discussions with some of our clients, like even small things you wouldn't even kind of think about on a day-to-day basis are definitely having an impact, especially related to COVID, it seems at this point, just kind of having all the resources on site to handle that. So I mean, things seem to be trending in the right direction with COVID. So hopefully some of those costs can kind of be reduced over time. But I think there's definitely kind of, again, back to that perfect storm discussion, like a lot of small pieces here and there that are really adding up to the costs of a project today. So kind of given your depth of experience in the industry, have you witnessed similar construction cost patterns to what we're seeing today in the past? When was it, and kind of how did it play out in the end?
We've definitely seen micro events that happened in various different periods, and I think the latest one that would have impacted a lot of the sites would be 2017 to 2019. There was a whole lot of increases on masonry, as an example, in the supply of masonry. That was a big hit to the projects. From a schedule perspective, they couldn't get enough masons to the sites, and the pricing that they were having on the regular site was tricky as well. It seemed to have leveled off at some point, and so it seems like whenever these events happen, there's a way that the market eventually evens out, and whether it be train of more masons or more mills opening to supply lumber and steel, right? So we definitely have seen these events happen. On the supply side, on the demand side, we've seen a very high level of sales activity in low rise this year, which would have also happened in about the 2016-2017 period. So it seems like the marketing is an indicator of what's happening on the demand side. If you're selling a lot now, 6 months to a year and a half's time, you should be getting a more demand side. There's more sites opening up. So I think the concern really would be now is are we at the point where all the ones that have sold, all the projects that have sold recently are about to start, and are they going to add to the demand issue in a lot of the items that we've just spoken about? I mean, that's also a concern, but we did have it before in the 2017, 2018 on the low rise and high rise, mostly formwork being an impacted line. We saw that settle off. It didn't drop, but it did settle off. And formwork nowadays is actually also under pressure again. So we've seen these impacts before. They always seem to manage to be around the short term, never really a long term concern. But the hope is that with what's actually happening in commodities and on the demand side, that they level off at some point, but just like they did in 2017, 2018.
Yeah, and it's interesting because we definitely saw interesting dynamic with pricing for end products back then as well. Obviously, there was some government intervention at that point to kind of cool it down in the market, which we're not seeing as of yet. But it will be interesting to see kind of how pricing kind of plays in line with the kind of run up and volatility we've seen in cost trends today. So we'll definitely have to keep an eye out on that. So for the next portion of this discussion, Donny was able to provide us with some average costs, just a quick slide on average costs for various infill construction projects. So Matt, if you could please put that slide up now. And Donny, if you don't mind just walking us through.
Thanks. It's quite a busy slide, so I'll take you guys through it quite slowly. But I think the important thing, you get a copy of it as well. It's a PDF. Max and Matt will share this after. But I think the important thing whenever you're using the cost per square foot ranges, you got to just remember these indicators. Like you really can't apply them to every project without having a little bit of adjustment on your site-specific cost premiums or savings. Like in some cases, you actually have some savings on your projects. And then also the other caution is, this wouldn't really be, the lower end of the ranges wouldn't really be applying to your, 5 units. You can't exactly expect to be at the lower end. You'd be probably at the high end, maybe even just up above it, depending if you've got a site-specific cost. But the above, the portion above, the part where we got apartments, houses and townhouses, that's the above grade construction. So that's applied to the above grade area. So what we would think is that your stick frame or walk-up apartments, you're looking at between 140 to 220 for your low to high rise, low to high range of the construction costs, and that would be an average of about $180 a square foot. Soft costs, we would say, is 50 to 70% of those numbers. So you'd average of $112 a square foot for your soft costs on your apartments. So those are the stick frames, up to 3 stories apartments, generally no elevator and things. So when it comes to the houses, a single detached, we would say that's at about 150 to 200 on the hard costs, an average of 175. And your soft costs averaging out about $93 a square foot. For your townhouses, you've got your stacked towns, which are more pricey than your infill towns at about 140 to 190. The infill's been 130 to 180, an average of 165 versus the infill towns of 155 for your hard costs. And then the range of your soft costs, we'd have it at a higher range of soft costs for your stacks, 50 to 70% of your hard costs, averaging at about 101, and your infills averaging at about 83. So those, the reality is, if you've got a site that you're actually in an area where there's a lot of high development charges, and you've got protracted debates and approvals, delays, and you've got issues with your financing or marketing to sell, you're going to be at the high end of your soft costs. So by all means, you could tip that 70% quite easy in your stacks, and maybe even go higher than that if you've got some unique things that are hitting your site because of how you're trying to battle approvals or you've got delays on your marketing and things. Anyway, when it comes to the above, none of those actually include the site servicing. So you'd have to add the site servicing for your walk-ups and stacks. It'd be a nominal amount in the 100 to 200,000 sort of level, but just as a number to your project. But when it comes to the site servicing for your townhouses and your detached, you'd actually have to add at least your 30 to 60K per lot. That
Donny, are you still there?
we've got one site where they're tipping over 80,000 per lot, and that's just because they're quite close to the water in Wasaga. So yes, Wasaga Beach, they've got real groundwater issues, and they have to deal with it, right? Below grade construction, you clearly don't want to build below grade because you don't get extra revenue for it generally, especially outside of the GTA. At the downtown core, you can generally get money for your below grade, and even if you do, it's at a loss. So the below grade, if you need the below grade construction, 130 to 160 of the below grade area is probably the range that you're at, and that's quite a bit higher than what you would have been building below grade construction a little while ago, and that's mainly because of the formwork and steel trades. I think the important thing is nobody can really fully predict at least where the commodities are going to go and the effects on construction. But we're basically saying that your typical escalation from one year to next is your 2 to 4%, depending on where you're in on the market. And when you lock in and things like that, we're thinking that the next year, from this quarter through to quarter 2 next year, it'll be between 8 and 12%. So quite a lot higher than the 2 to 4% that we typically see. So I think all depends when you're locking in your trades. Get that sometimes you've actually got yourself locked in at a lower rate, so you won't actually feel that. But if you're still at the initial performance stage, you need to be allowing some significant escalation to your performance to just make sense of where you're going to go on the cost side.
Great, and we're gonna save majority of questions to the end, but I saw something pop up about HST. So do these figures include HST costs?
No, the costs that we always talk about are without the HST, because HST you typically get back during construction, and it's more of a revenue adjust. So these would exclude your HST.
Okay, great. And obviously these are just kind of average figures for builds across the board here. And I really think these are quite powerful, these figures. Obviously you have a lot of experience, you're reviewing a lot of budgets, so you have kind of a pretty firm grasp on where costs are. So given that these are just average costs, can you provide some kind of site-specific cost premiums or savings that can have a major impact on these average figures?
Yeah, great question, because whenever you look at cost guides and the cost ranges, you've really got to look at your project as well. And I think whether you're building below grade or not, I mean, it really does impact how much your construction is going to cost as an overall. Like your stacked townhouses, we've seen some projects not feasible because they had to build a whole lot of below grade, and as soon as they got their head around, or they could somehow manage to get the surface parking to deal with everything they needed to sell the lots and meet the city requirements, all of a sudden became profitable. So really the amount of below grade is a big factor. Your above grade apartments, I think everybody focuses in on the net saleable or net leasable, which is a good factor to impact in this. So everything you build in an apartment is not what you sell. So for every square foot you build, you may be selling only 80 to 85% of the space. If you've got a very inefficient design on the above grade, you may end up with with an 80% or 75%. You've given too many amenities. You've only got 70%. That's going to really significantly hit how your project's going to run, and not necessarily on the construction costs, because the construction costs may still even out to these sort of numbers, but it's more what can happen on the revenue side. But I think the big things that people also have to be careful on is add-in features. The things that sell generally cost extra. So apartments with a lot of terrace, that adds a lot of money onto your bill. So you can quite easily get up to the upper 200s just by adding terraces to your walk-up apartments. Townhouses with rooftop terraces, it adds money. It's a sellable feature, but it does add money onto your construction as well. So I'd say some design features could impact what you're doing as well. And then I mentioned the design features, also the site-specific stuff that can happen in your site servicing. It's such a big range, 30 to 60K. It's just because sometimes you actually have to do a redivert of a creek, or you've got some big site servicing issues, with your groundwater, projects, okay, like the one I mentioned in the South Beach. So you really do want to make sense of those cost premiums as quick as you can, and sometimes cost savings, because you could actually have some really good things that are saving you money and meaning that you're on the low end of the spectrum as well.
Okay, great. And just kind of a further follow-up on this, just in regards to kind of risks that could impact the budget. So I guess from like a high level perspective, are there any major risks that can really shift these figures around as well in a construction budget?
Yeah, with cost increases at the high rates that they're at right now, the risk is locking in too early for when the cost increases are coming. Too late when the cost increases are coming. So in other words, you're actually already realizing some increases that you maybe shouldn't have. And when the costs are dropping, that you're not locking in late enough. So I think you really have to be careful on when you lock. Getting quotes in, locking them in, asking suppliers if they'll agree. I mean, at the moment, I think a lot of the suppliers are very, very careful to not lock in too long, but if you can get them to lock in their quotations for more than the 90-day kind of period that fully covers you. The risk on the revenue side is a big risk as well. I mean, I think if you actually have revenues climbing at the same rates of cost, and in the perfect world, you lock in your revenues in at the same time as you lock in your hard costs. I think playing that game of, okay, locking in your hard costs and locking in your revenues at the latest possible moment or at the earliest possible moment, depending on how each of those are trending, can really significantly impact the risk.
And just in regards to thinking about how to mitigate some of these risks, like do you have any ideas as far as what people should be budgeting as a contingency when going into a project today?
Yeah, we would hands down 5% of the hard cost, 5% of the typical approach. I think if you're trying to get your lender on side on a deal and you're not going to start until a certain point. I know most developers go in with today's cost, today's revenues. But if you do feel that you've still got a little ways to go on your approvals and you haven't locked in your revenues yet, you probably wanted an extra factor in there just to be able to deal with the unusual escalations that we have right now. I think that would be probably a good thing to try work in there, at least 10% maybe instead of the 5%. I think the biggest thing that we would see as advice to our developers right now, developer clients, is if you get sold today, start tomorrow, like as soon as you can. So a lot of the developers wouldn't spend money on the design because they want to get their sales done, and then they focus on their design, then they get their permits, then they get going on the construction. You don't really have the luxury of time. Like the sooner you can get shovel in the ground, the better. In a market where costs are going up as much as they are. I mean, revenues locked in, you only have a finite number of amount of equity, profit that's due to you at the end of the project. If you delay, you will add extra costs, and that's the problem that I think a lot of people have right now, is that they may be selling a bit too soon, that they're actually not shovel ready. Our advice would definitely be get shovel ready as quick as you can, as soon as you can after your sales, in the market that we're in right now, right? I think that would probably be the biggest way to maximize your profits.
Yeah, and it's interesting because obviously from a lender's perspective, like we, prior to committing on something, we want to see that there is demand for that product, and we do want to see some pre-sales in place. But that's kind of, I think that's one of the benefits of working with Foremost here is we've got a bit more leeway on pre-sales. So we can understand the end product, we can understand kind of demand for that end product. We're able to kind of work with our clients, give some leeway on the pre-sales, and maybe be able to tighten that gap as far as selling the units and approval. So that's an interesting point. And I also think it's interesting to look back and relate it to, as you mentioned, kind of the last time we saw some volatility in prices in 2017, 2018, and it seems like there were similar sort of trends on sales. Like, can you speak a bit to that? I know there were quite a bit of canceled projects out there.
Exactly. So the 2017, 2018, a lot of canceled projects, and I think the reality is it was the same kind of atmosphere, where your revenues are locked in, whether lenders asked for pre-sales or not. Like some builders in that sort of period were selling all their project out. So maybe potentially trying to stop for some losses because they thought that maybe the revenues are going to drop. But the reality is when they sold all their product, they were locked in on the revenue side of the performance. So they ended up having all these cost escalations at that point. On the condo side, it was mainly the formwork trade that caused a lot of cancellations. But there were other things as well. The soft costs were hitting a lot of projects at that point. City of Toronto had very sizable increases to the development charges, and a lot of other cities had very sizable increases. The region of York had very sizable increase to development charges. So there were a lot of things hitting these projects. So all of a sudden, where they had a certain amount of profit, it got zeroed out or went into a loss territory. So where they couldn't bank the deals, or they just walk away from the sale. So that's something that is very, very likely in the next short term, because depending on where people are locking in on the revenue side, and where they're locking in on the hard cost side, they potentially are having reduced profits as they go.
Interesting. And so as far as profitability is concerned, like looking at these increased costs and obviously increased pricing on due to demand, can you give the listeners kind of a bit of an understanding of kind of average profitability expectations for these types of projects?
I suppose it all comes down to when we do a lot of performance for developers, and I think when we get them to the 12 to 15% profit over cost, that's generally one that they're quite happy to take to their lenders and get their financing with. But I think clearly if they only come into the lenders at the point that they've already been hit on the cost side, but their revenues are already locked in, they're getting squeezed there. So we are seeing downward pressure on the profits for sure. For a shovel-ready project, for them to be 5% plus is not unheard of right now. So, as low as 5%. And we've got quite a few clients that have, pipeline buildings, and they've got a name in the market. So they still go ahead, even though their profits are down to a skinny 1%, 2%, they still have to go ahead just because they don't want to, it's the whole, their name is worth more than the profit that they may lose on that deal.
Yeah. Reputation always plays a big role. So just again on profitability, like any tips for builders that maybe listen to this call to kind of increase their probability of success on a project and a successful project and a profitable project?
Yeah, I think I've spoken to time before you actually get started, but not to downplay how important it is to actually get your product done as quick as you can. I mean, selecting the right team, your trades that work with you. A lot of people have the approach of they work with the same teams. I think a lot of people now will be forced to try others because of the cost pressures. You really have to be asking the questions about performance and past performance with these trades, because you're going to be trying new trades. You're not the only one that's going to be asking for their attention and for their schedule, for their teams to be at your site. There's going to be a lot of other people barking up and down for their drywall crews to be hitting their sites. So you really want to be trying to pay attention to that. I think it's not uncommon right now for projects to be delayed quite a few months, and the ones that actually make better profits are the ones that get finished quicker. So.
Okay, great. And so kind of just final question here before we jump into Q&A, because it does look like we have some questions lined up there, and we may have already kind of been over this, but just can you give any kind of best advice for and practices for running a cost efficient site. Are there any kind of common mistakes or pitfalls that you see builders falling into these days?
I don't know if it's quite a current trend versus developers that spend too little on the overhead. Sometimes they pay for it in the other line items. So when it comes to your site supervision and how you manage the site, if you throw a little bit of money at that, that sometimes can give you some savings on the line items. You don't have as many trades not showing up and not dealing with dealing with as many schedule issues and change order issues. I think with cost increases the way they are right now, a lot of the trades are going to be pushing for changes, and they've got a locked in price, and they made a mistake. They're going to be coming to you to try and get it and see if maybe you can eat up some of that mistake. So you're going to probably get a lot of change order requests, and how you can manage that and how you can prevent that by being proactive with your management team is probably going to help you and maximize your profits as well.
Okay, great. Okay, so I think we've kind of covered everything that we had kind of discussed. I think there's a lot of interesting discussion there, and I think we did a great job with those topics. So it looks like we've just got some Q&A here. Yeah, sorry.
Sorry, yeah, could I just also mention one thing? I think when you're trying to negotiate your sale, your products from the trades, so you actually have a line item that you're trying to get committed to the trade. A lot of the trades are actually getting a lot more sensitive on cash flow and a lot more demanding on cash flow. And what I mean by that is asking for very significant deposits upfront. A lot of times lenders can't follow, so you probably just, it doesn't hurt to have some extra cash on the side of your deal that you actually can deal with some of those extra deposits. That may actually get you to lock in for an extra 30 days, and that may mean that you've got an extra couple of blocks covered with the same lumber price or something like that, right? So it really is, running lean with equity is probably not a good thing right now. Like, I think you may need a little bit of extra equity on the side to be able to deal with some of those requests. We have one site, they had to pay for the lumber raw upfront to lock it in, and the lumber wasn't expected for a couple of months still onto the site, but they were quite happy to do that because they saw where lumber was going, and I think they had the cash to do that. And I think you as a developer, I think you probably just wanted to have that extra an extra toolkit, if you like, a little bit of extra cash that you can deal with some of these deposits.
Yeah, and that's really interesting. I mean, I think whenever we talk with clients, like, we always kind of, a big thing in our underwriting process is to have that liquidity, because even putting the movements in construction costs aside, like, there's always something that comes up during a project. So it's always that, I'd say that's a key part of our underwriting process. Just make sure that the clients have the liquidity, enough money in their back pocket, where if something does come up throughout the project, just kind of have the ability to handle that and kind of keep moving things forward. So I think that's a great point, and definitely something that builders today should really take into consideration. So just moving on to Q&A, looks like we've got a couple questions here. If anybody else has any questions, please put them in now. So the first one here, I think they're just looking for some clarification in regards to the cost for below grade / basement construction when it comes to single family homes. So when you had those additional figures there, is that including kind of a single family custom home where you have just kind of a basic foundation and kind of maybe some basic basement finishes?
Yeah, your above grade numbers on that chart that we were showing, that would include foundation. So it's not like you wouldn't have foundations for that above grade. It should cover you in those ranges. When it comes to basement construction, most people speak on a per units for basement construction, especially if it's unfinished basements. And quite a lot of the time you're asking for extra revenue for that, and you gotta weigh up that metric of whether it's worth doing the unfinished basement to be able to get the sale, and if you can get extra cash revenues for that makes sense. But the $130 to $150, I think that would more apply for the apartments and the single detached, that range. That cost range of 130 to 160 is more for where you've got a bit more sizable below grade construction. You can make some efficiencies happen.
Okay, great. So the next question here is, Donnie, do you have an opinion on what will happen with housing starts going forward? These could impact demand for raw materials. Will we be better off slowing down our construction in hopes of a decline in prices?
Yeah, great question. I think right now revenues are up. So housing starts, if anything, are going to go up. I can't see them slowing down. I think the reality is what you're seeing right now on the cost side is probably the only thing that can maybe cool down a couple of markets. We're seeing a lot of housing starts in other areas where maybe the performance didn't make sense before either, right? They're going up as well. So we've got quite a few projects in Collingwood right now and in the Muskokas, which are probably projects that were on the shelf waiting to make sense of revenues, and now they are making sense. So I think you may actually end up having some extra demand stuff happening in some smaller markets as well.
Okay, great. And next question here. So Donnie, how would these costs fluctuate from province to province?
Province to province, it's a good question. I think we're specialists in Ontario. We've got a couple of BC projects, and I worked out in BC for a couple of years, and I know their metrics are completely different to ours, and in that, you know, for example, you know, mechanical, electrical, you know, it's completely different numbers to ours. I would use these for Ontario. For other provinces, there are some indices out there that you could use to be able to try make the adjustments. StatsCan would probably be the best source for that. But yeah, our projects, because this is based on our database of projects, and a predictor for it using current contracted rates. And our database is mostly like 99% Ontario. So.
Okay, great. So next question here is, what is the cost associated with building an underground parking garage for a stacked condo per square foot for one level and two levels?
Yeah, the rates that we gave there, the 130 to 160 for below grade on your stacks and on your apartment buildings, I think that would cover you for 1 to 2 floors. As soon as you go to more, you know, 3 levels or more, then you start to get into some other issues that start to hit you, like what are you doing with the water? Are you having to do a tub design and things like that? So you know, that may end up being a different metric, but that should be good for 1 to 2 typically.
Great. Okay, next one here is, what would the average site servicing cost for a mid-rise apartment building without underground parking?
Yeah. Line item we would carry just as a sum, and then clearly if you had that estimated by a civil engineer, it's better. But for walk-up apartments and a stacks, that's generally the kind of level that we would see added, and that's over and above what the mechanical trade would be in on the building, and your electrical trade would be in on the building. So your cost per square foot would be from building edge and to property line, you know, would be the site servicing.
Okay, great. And I think this is the last question here. So have you seen any recent trends in projects that Pelican has been working on, or any of the services that you've provided, kind of in terms of types of bill, location, clients, etc.?
Yeah, I mentioned one of the trends, which you know, we've seen more projects outside of GTA starting than we've seen in a while. Like so some areas where we didn't have, maybe we had 1 Muskoka project live at any point. Now we've got 5. Like, you know, it just seems to be there's a lot of areas where there's a buzz on the revenue side, and that's causing projects to happen. We are seeing quite a lot more low rise, and you know, at the start we were talking about the impact on commodities. we're seeing that as well. Like, I mean, we're seeing more low-rise and mid-rise performers hitting our desks, and more performers and mid-rise commitments hitting our desks as well. So when we're monitoring projects, you know, we're seeing quite a lot of changes between when the performers were done to commit and to actually when the start of construction happened, and that's a factor of the cost increases. You know, we're seeing that as well. So, so smaller communities, more projects making sense, and we're seeing more of those. The performers, we're seeing revisions to those performers because now, we need to rerun it. We've got new revenues, we've got new costs, and the actual big changes between when the lines are committed and then when we actually start the first line advance.
Okay, great. And so I think that's it with the Q&A here. So just the last question I had, like kind of bringing this in to all our discussions for Builders IQ is kind of, are you seeing any opportunities in the current market if you were a builder and had some funds for a project, like what type of project would you be looking to take on today?
Good question. I mean, I know that half of that answer is on the revenue side. So my guess is that there's some revenues that are making certain asset classes very appealing. I think the interesting thing is we often have people that have a site and it's blank and it doesn't have any approvals on it yet, and they're debating high rise or low rise. And I think it doesn't necessarily mean that the high rise is going to make sense on your site. And I think you know what construction costs are doing and what revenues are doing may make the stacked townhouses as an option, a better option for you. I think opportunities wise, I see that right now the revenues is a big opportunity for a lot of people. And on the cost side, I think on the high rise and the low rise is precious right now. So I don't think they're really pushing people. The cost side isn't pushing people away from asset types. I think it's maybe more the revenues that are going.
Interesting. Yeah, and I think that brings us kind of a full loop from our previous discussion on lean construction and how important that is in today's current market, given all the factors at play. So Donny, I really appreciate you joining us today. I think this was a very informative discussion on kind of infill construction costs. I hope the listeners were able to kind of get some good knowledge out of this discussion and kind of, again, help them guide through some of the volatility we're currently seeing. So we really appreciate you having you on today. Thanks everybody for joining us. Stay tuned for more information on the next Builders IQ, and hope everybody has a great day. Thanks.
Thanks everybody. Appreciate it.